So I'm David Adams, welcome. This is our first quarter 2015 market update. And so here you are 2015, and just as we planned, quite a bit of volatility. So no more Mr. Nice market, if you will, like we've seen the past couple of years. But that's okay, so let's talk about what we're seeing out there. It's very common after a bull market, like we've seen for the past 6 years, for volatility to pick up. I like to call it bumper bowling that we've had for the past 5 years. And no one really knew that we were playing that, and we had the bumpers on, but they've come off. And what I mean by that is the headlines are starting to matter again. So the media is controlling a lot of this volatility. Perfect example, I heard a story, and you may have heard me talk about this before. Drew Brees had a $76 bill at a Chinese restaurant. The media jumped all over him about leaving a $4 tip. But what they didn't tell you, and in my opinion this matters quite a bit, is that it was a to-go order, that he got it from a pickup window. So does that change your opinion of the story? Maybe, maybe not. My point is that media sensationalism is here again, and it's affecting the markets. So one thing I really wanted to hit on today, I've spent a lot of time lately talking with various financial advisors, top advisors, study groups, and conferences I've been to, and really talking about how asset allocation has really looked pretty pathetic the past year against the S&P, really the past few years. So if I'm a client, I think it's a very fair and logical question to say, you know, David, why wouldn't we just track the S&P 500 and keep it simple? And that's a great question. But the fact remains that even though the S&P 500 has looked like a rock star for the past couple of years, remember in 2008 to 2009, it lost over 50% from peak to trough. Actually, I think it was 60%. Whereas many of the risk-managed asset allocation models, like the ones that we run, lost about half of that. So as I've always said, you really make your money in the market, not in the good years, but by not losing as much in the bad years. Investors really used to expect getting 8% on their stocks, getting 6% on the fixed income part of their portfolio or the bonds. So having a 60-40 portfolio, you could expect to get 7% without a lot of stress. But now investors are having to reset those expectations to maybe 0 to 2% for their bonds for the foreseeable future. So with bonds not paying a lot, it's really making it hard to get those kind of gains that clients want, especially when they're not willing to increase their stock exposure and take more risk. It's a really tough position to be in, but it's very important that we're having these heart-to-heart conversations with our clients to really give them the best chance of reaching their goals. So I'll stop whining about how hard it is to be a financial advisor and get back to the market economy, which is the market and the economy, which is why I'm here today. Okay, so many of you know our chief economist, Jeff Salt, who's spoken at several of our client events. His position is that we're 6 years into what he calls a 15-year secular bull market, and he's remained bullish really since calling the bottom of the market in 2009 on MSNBC, and at that point he was telling the traders, institutional traders, to go all in and put all their cash in the market. Now since then he has suggested taking some of the gains off the table, but for those of us who oversee risk-managed diversified portfolios like our team does, he's really suggested keeping your equities at your normal bullish levels and staying heavily invested in stocks and waiting for a shift in the Dow theory, which is the philosophy he uses as far as when to get in and out of the market, for there to be a sell signal. And according to him, we're not anywhere close yet, and I would concur. Also, Brian Belsky over at BMO believes that the S&P 500 is going to hit 4,200 by 2024. I'm all for it. I'm not fighting that. But how did he come up with this? His argument, again, is that we're 6 years into this 15-year secular bull, and that the average during these bull markets is about 16%. And if you think about that, if we have 10 years left, that gives us still about a 10% average annual rate of return to finish out this bull cycle. Another way to look at this, let's talk about the median price-earnings ratio over the history of the S&P has been in that 15.5 ballpark. So if you use that, and I'm going to get really nerdy, use some really nerdy CPA math here. If you use that logic and you look at the 2020 earnings estimate on the S&P, which is like $183, that would imply about $28.40 by 2020 in the S&P. And again, that's about a little over 10% rate of return between now and 2020. So several ways to look at this that would paint a picture that the S&P has a little bit more run in this bull market. So again, I'll say this though, I don't think that the S&P is cheap. I think that it's also not expensive. I think it's a little frothy, and that's in my opinion, of course. But in periods like this where the PE ratio is between 16 to 19 or just a little bit ahead of its historical average, usually the markets continue to go up the majority of the time. So keep that in mind. Now the Fed, and Jeff Salt, over the course of his 44 years, he was commenting to us in a recent staff meeting that he's really seen the Fed care about the equity in the bond markets when it's making its policy and having discussions and talking about its upcoming moves. And that's been really good for the market. And it's a great sign that they're starting to really get it, that the market does listen to what they say. So I think that's good. I've heard several top think tanks say that the S&P will increase 10 to 12% this year if the Fed maintains a policy of not raising rates or doing it in baby steps, such as maybe 25 basis points this summer and then waiting to see how the market reacts. So I'm very hopeful that they're going to proceed that way. Historically, when the 10-year Treasury gets closer to 5% or on its way up to 5%, usually the market has positive returns. And once it gets to 5% or above, the market starts to typically, that's usually negative for the market. So my point of that is we have a long way to go before that's really a concern. Also, let's talk about the dollar. It's been strengthening, and when the dollar is strengthening and up over 10% like it was in 2014, every single time that's happened, the S&P's been up with an average rate of return of 15%. So a lot of these indicators are pointing to the same thing. Raymond James, our energy team, says that we're nearing the bottom for energy, and if crude oil even goes up a little, back to let's say over 50 bucks a barrel, that should really damper some of the media frenzy and some of the concerns about oil. And this will really, things will start to settle. And this is ultimately a good thing for the U.S. economy. A simple basic concept I heard from the Millikan Institute is that whenever there's access to capital and at cheap rates, like it is now, economies tend to grow. So there's a lot of cash out there. That's good. And the 2008 recession was really a good cleansing process. And we have much better balance sheets now. And that's companies, individuals, a lot more cash, a lot healthier. We lost, 9 million jobs, I think, during the recession, and we've recovered all of them and then some. Wages are increasing. All these are good signs. Unemployment is actually under 3% now for those with a college degree. Without a college degree, it's around 8%. Look at that another way. The average earnings for someone with just a high school degree is $30,000, but now it's over $85,000 for those with an advanced degree. So education has mattered, and it's continuing to matter in this country for unemployment and wage earning. Back to cash. I talked about the balance sheets being healthier. There's $11 trillion of cash in the money supply. Put that in perspective, it's normally about $9 trillion. So that's $2 trillion of excess cash waiting to get invested in the market. $2 trillion is a lot of money. Put that in perspective. $1 trillion. This is an interesting fact. It's interesting to me at least. 1 trillion seconds, or 1 million seconds is 12 days. 1 trillion seconds is 32,000 years. So there's two of those, 2 trillion, or what is that? 64,000 years worth of cash on the sidelines waiting to be invested and put to a productive asset. In my opinion, it's really going to be hard to see a 30% correction like we had in 08, 30 or 40% with those dynamics. A lot of advisors, I hear them talking about it all the time. God, David, we're really waiting for that 15% correction in the S&P, and then it doesn't happen. So then it's fine, just give me a 10%, give me 5%. They want to get into the market at a lower point, and the reality is the market keeps getting bought back because everybody's expecting a pullback. And the average year in the market, the S&P will drop about 14% at some point. So that's normal, but we're seeing it go right back up. Now, it's also important, I want to talk about bonds for a second, to have active bond managers in your portfolios. With rates so low and bonds doing basically nothing, this is very important. Interesting fact, the U.S. is only 36% of global bonds. So you think about that, back in 1989, actually the U.S. made up 80% of the global bond market. And emerging markets used to be 1%, and now they account for 14%. So my point of that is you need really good managers to know where to put your money in the fixed income market. We really seem to think that this year is going to be a good year for international stocks. They've had several years where they've underperformed, and we think this is the year they kind of go back to providing some value in the portfolio. Okay, so an interesting stat about CDs. Back in 2006, to get $100,000 of income for a retiree from their CDs, you only needed to have about 1.9 million in CDs to get that 100,000 because of where rates were at. Now today, you would need $77 million invested in CDs to get $100,000 of income. It's not going to work for most retirees unless you have $77 million, and if you do, come see me. So according to a study by, I think it was a group, Benson Biebauer, the average investor did about 2% return over the past 20 years versus the market doing 9%. Why is this? Bad timing, emotions. As humans, we're all wired to fail at investing. We know that. But remember that thing that looks like the periodic table of elements that if you're a client, you've seen me show, called the Callan chart. All you need to do is average 7.2% a year for a 10-year period to double your money. It's the rule of 72. The best way to do that is with a diversified portfolio, not just the S&P 500. I'm begging everybody listening to this, please stop using the S&P 500 as your only benchmark. It's a good benchmark over 10 or 20 years. It's a horrible benchmark to peg your portfolio against over 1 or 2 years. Oh, and one more thing before I let you go. How could I forget to talk about Washington? Obama really has two directions he can go. He can compromise and play kind of the middle, play in the middle of the aisle during the last part of his term, and the market, in my opinion, will love this approach. Or he can really dig his heels in and push his agenda, veto bills. But the Democrats are very aware of what happened with Grover Cleveland actually back during his term, where he really ruined it for the Democrats for the next 16 years. So we'll see which direction Obama takes, but we all know no matter what Obama and the Democrats do, the Republicans in the 2016 elections, we know they're probably going to screw it up. And I probably shouldn't have said that, but they're notorious for running a very bad marketing campaign. So we'll see what happens in the elections in 2016. I probably ought to go after that comment. I'm David Adams. This is my Q1 2015 market update. And please, 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 after all this talk about the stock market, remember to focus on what's important in life, your friends, your family, your faith, your health, and just try to remain confident in the financial plan that you have set up. That's what you have us for. Thank you.